Are we in an AI stock market bubble? The US stock market has been soaring, driven largely by artificial intelligence. But are we witnessing the formation of a massive bubble? And how reasonable is it to compare today's AI boom to the dot-com bubble of the late 1990s? Let's take a closer look. The dot-com era was a period of speculative excitement fueled by the commercialization of the internet. Investors believed that almost any company associated with the internet could become the next industry giant. Low interest rates, combined with capital gains tax cuts introduced in 1997, helped fuel an enormous wave of investment. This is why we call it a bubble. Many of the companies driving the market higher at that time generated little or no profit. In many cases, they had negative cash flow. Storytelling, visibility, and excitement mattered far more than actual financial performance. Investors were driven by optimism and the fear of missing out. Valuations reflected this enthusiasm. The average price-to-earnings ratio reached around 65 times earnings, an extremely high level by historical standards. Eventually, the bubble burst. When the Federal Reserve raised interest rates and many companies continued burning cash faster than they could generate revenue, investor confidence collapsed, and the market experienced a dramatic downturn. Fast forward to today, artificial intelligence has become one of the most powerful forces driving the US stock market. The largest technology companies now account for roughly 40% of the S&P 500's total market value. But there is an important difference. Unlike many dot-com companies, today's AI leaders are producing substantial revenue and profits. Companies such as Nvidia, Microsoft, Alphabet, Meta, and Amazon continue to report strong earnings growth quarter after quarter. Even though these companies are already massive, many are still delivering revenue growth of 25% to 30%, profit growth exceeding 70%, and impressive earnings per share growth. Valuations also tell a different story. While dot-com stocks often traded at around 65 times earnings, many leading AI-related companies currently trade closer to 25 to 30 times earnings. In other words, today's market is not being driven purely by speculation. Strong financial performance is supporting much of the growth we see. That said, there are still similarities. Market concentration is unusually high, with a handful of companies accounting for a significant share of overall market gains. We also see massive investment flowing into infrastructure, such as data centers, advanced chips, and AI development platforms. Nvidia's extraordinary rise is one example. And of course, the fear of missing out remains a powerful force among investors. Another important difference is the interest rate environment. During much of the dot-com era, rates were relatively low. In contrast, many AI companies have continued to grow despite the higher interest rates seen in recent years. This suggests that their business models may be fundamentally stronger. Of course, none of this means markets cannot decline. Corrections and pullbacks are a natural part of investing, and nobody can accurately predict when they will occur. Markets always find reasons to move in both directions. These are simply my observations and research, not financial advice. So what do you think? Are we watching another bubble form, or are we witnessing the early stages of a technological revolution? Thanks for watching.